Thank you so much for joining us tonight to our fourth Nursepreneurs Strategy Conquer Real Estate webinar. We're so happy that you guys are here with us tonight. Tonight, we'll be talking about how to evaluate a passive investment opportunity.
And she froze. Like she mentioned, we're going to be talking about how to evaluate passive investment opportunities in real estate syndications. This is our fourth webinar. All right, let's start with the disclaimer as usual. Nancy, Fran, and I want to mention the information we provided for you guys today is only for educational purposes. Please note that real estate investment involve risk while also can provide substantial returns. Therefore, as nursepreneurs, always stress important that our prospective investors should conduct your own due diligence before investing in any and every investment decision.
So who are we? I'm Fran. We have Pat and Nancy here with us today, and we're a trio of nursepreneurs. Our goal is to educate other nurses, healthcare providers, and any other specialty, really. We're welcome to all investors to just educate them on how they can invest their money to gain financial freedom and independence through savvy real estate investing.
Let's go over our agenda for tonight. Tonight, we'll be able to help you understand key financial metrics that are essential for assessing potential returns and risks of a passive investment opportunity. We're also going to go over some of the red flags to avoid unfavorable investments to protect your capital. As nurses, we work so hard to take care of other people. We get the privilege of taking care of our patients and nursing them to health, but sometimes we forget about taking care of ourselves, and we can't feed out of an empty cup. So it's important that we also take care of our own health, and that includes our financial health as well.
So let's go over a little bit of fundamental stuff. What is real estate syndication? This is going to be a good recap for many of you that have joined us in the past, and it's going to be a good fundamental to start, with the light conversation about syndication for many of you that join us for the first time. So what is real estate syndication? The easy definition is when regular people, just you and I, come together to purchase large apartment complexes. There's two roles in syndication, which are general partners or active investors, just Nancy, Fran, and I, and limited partners or passive investors, just like you guys, where you guys provide capital without doing any legwork. So why Nancy, Fran, and I love syndication. So syndication offer a very good passive investment opportunity for you guys, which is BC healthcare professionals and nurses, to participate in a large real estate deals with limited involvement, which means you don't need to be a landlord, you don't need to deal with the tenant, do the maintenance. So you provide capital while we're doing the legwork. There are several key metrics that you're going to be hearing over and over again for, when you talk about real estate syndication. But in this webinar, we're going to be focusing on three key metrics, which are cap rate, cash on cash, and equity multiple.
So let's start with the first one, right? So we have cap rate, which is capitalization rate. And the best way to define that is the net operating income to the value of the purchase price. And why would this ratio be important? It's because it determines the risk that you're taking upon when investing into a real estate deal. So why does this matter? It helps you to compare between different investment opportunities so that you know how much risk you're able to take as an investor. With higher cap rates, you have a higher risk of investment, but you also have potential for higher returns. With lower cap rate, we found that the market is a little more stable and in a desired area. So your returns may not be as good, but at least it's stable.
Now, let's go over another key metric, which is cash on cash return. Cash on cash return is the annual return of the cash investment that you get. So it's important to know what your annual cash on cash return is so that you're able to compare one investment to the next one. This will make you make a better decision on which investment opportunity is best for you. So to calculate cash on cash return, you would divide your yearly cash flow from your investment by your initial investment. So for example, if you invest $200,000 in one of our passive investment opportunities, and over a year you get $20,000 of cash flow, divide your $20,000 cash flow by your initial investment, which is $200,000, that would give you a 10% cash on cash return. Obviously, the higher the cash on cash return, the higher the profit on your investment.
So let's go over equity multiple. So what is equity multiple? Simple. Equity model is telling the passive investor how much money you expect to get return from your investment. It's easier, calculation when you calculate by use the total cash received from your investment divided by total cash invested. For example, if you invest with us $100,000, and over the life of your investment, you receive $200,000 back. The total money received, which is $200,000, you divide it by total cash that you initially invested, which is $100,000. That give you equity multiple is by 2x, which is a very great investment return. So why is this important? It's tell you as a passive investor the total amount of money that you expect to get from your investment. It's just a straightforward measure of the overall profitability of your investment. Is help you make better understanding of your deals that presenting to you. So straight to the point, easy to calculate it, easier to compare side by side when you have multiple deals in place.
All right, so what is the importance of the three key metrics that we went over? Cap rate, cash on cash, equity multiple. It's important to understand that terminology so that when you're making an investment decision, you're making an informed decision. It also allows you to assess the risk and how much risk you're able to take as a passive investor. And it also allows you to compare apples to apples and oranges to oranges so that when you're making a decision, you have the clear numbers to understand which is in your best convenience.
Something very important that we should be able to do when we have a passive investment opportunity is able to identify red flags. This will help you to evaluate possible passive investment opportunity and help you avoid getting into deals that are not favorable for you. You don't want to be stuck in a deal that's 5, 7, or 10 years long and it's not making you any money. So us identifying red flags early on can save us from making poor investment decisions. Some of the common red flags and the ones that we will be going over tonight are overly optimistic projections, lack of transparency, and poorly structured deals.
And also unrealistic exit strategies too, right?
Oh, I'm so sorry. Yes.
No problem.
I can't see that on my screen.
I got you, Beth.
Thank you.
So let's go over the first common red flag, which is the overly optimistic projections. When the projections that assume unusually high returns or rapid appreciation without any solid basis. There's indicators that you can be a lookout for. First one is unrealistically high rental income growth rates. The second one is low vacancy rates that do not align with the market norms. And the third one is underestimated operating expenses. Let's give you one example, the low vacancy rates. So when you have a deal presented to you by the general partner or active investors, and they tell you that the vacancy rate for that particular investment opportunity is at 0%, which means like 365 days a year, you have 0%, like vacancy rate, which means you're fully occupied at all time. Is that really realistic? Probably not. right? Because you have to take in consideration of when you have like the previous resident move out, and you have to get the unit up and running and ready for the new resident to move in. So that's the period of time, that the gap between the previous tenant and residents and the new resident, that you have to take that into consideration as well. Or for example, when Nancy, Fran, and I look into the potential deals that we're going to be investing in, we're looking for value add, which means there's going to be units that we have to leave empty for us to do a renovation, so we can increase rent, which is increase the property value. So that we should take that in consideration as well. That's why 0% vacancy rate is super unrealistic. And you should question that when they tell you that, the vacancy rate is 0%. So the more realistic vacancy rate is like 5 to 10%, that what we usually looking for. There's several questions that you can ask active investor or general partner when you want to evaluate that if any red flag on overly optimistic projections. The first question you can ask is, what are the assumptions behind these projections? How do these presumptions compare with historical data and market averages? And the last question you can ask is, have the sensitivity analysis been performed to test the different scenarios?
All right, so the next red flag is the lack of transparency. So when an active investor isn't forthcoming with all of the information or isn't providing all of the information, that should be a red flag to you. And some of the indicators could be avoiding certain details or the lack of financial statements or performance reports. And one of the ways that I like to translate this is, imagine if you go to the hospital, you have a new diagnosis, and the doctor tells you that he wants to do an operation but isn't telling you the risks of the procedure. That would be a lack of transparency. Would you let this doctor operate on you? Probably not, because I wouldn't. So some of the questions that you can ask in real estate to avoid lack in transparency would be, can you provide the detailed financial projections, past performance data? How often will this investor update you, whether it be good or bad news? And how can you go about sharing that information? What is the communication plan?
So now let's go over poorly structured deals. So deals that are structured in favor of the active investors like Pat, Fran, and I, over the expense of a passive investor like some of you here, that would be a poorly structured deal. That would be a deal that you would want to avoid, and that once you see that, it should trigger a red flag right away. Some of the indicators to know when there's a poorly structured deal would be high fees and expenses that reduce your returns, or also when they put any conflicts or random distributions that you don't understand, that would be another red flag. Or whenever there's a lack of alignment between the active investor and the passive investor. For example, if the active investor is bringing you a deal that is charging you high fees, like finder's fees and acquisition fees and travel fees and all these fees, and then they're not investing any money, I would be concerned about that. Like, why are you charging me all these fees, but then you're not putting any of your own money? You don't have any skin in the game. That would be something that would trigger a huge red flag for me. Some of the questions that you can ask are, what are the total fees and expenses associated with this investment? What are they for? What do you need them? And exactly what are they going to cover? And you can also ask, how are the profits and the losses shared between the sponsor and the investor? You don't want the sponsor or the active investor to tell you that all the losses are going to be the responsibility of the passive investor.
So the last red flag that we're going to be talking about today is unrealistic exit strategies. So when there's exit strategy that rely on overly optimistic market conditions or assumptions, there's several indicators that you can be a lookout for. The first one is dependence on selling the property at a high price within a short time frame. The second one is lack of contingency plans for market downturns. And the third one is over reliance on refinancing as the primary exit strategy. The good example is when the general partner, active investor, presented you with the deal and tell you that their exit strategy is they plan to sell this property within 10 months and will give you a substantial returns of your investment. You know, be realistic here. 10 months, you really don't get to do a lot of value add or actually able to, you know, increase the value of your property as much. So most likely you're not going to get a substantial return of your investment if you hold the property only for 10 months. So that's really unrealistic. And you should question that when they present you with the deal with that type of exit strategy. The question that you can ask the active investor, for example, what are the planned exit strategies and what the assumptions do they rely on? Are there contingency plans if the market conditions change? And how flexible is the exit strategy if unforeseen events occur? They're really good planning, you know, underwriting plan exit strategy. You should have like plan A and plan B in place. If the plan A doesn't work, for example, if Nancy, Fran, and I feel like, you know, planning to hold a property for 10 years, for example, but then when the 10 years come, the market is not favorable for us to really sell the property, then we should looking for plan B, which are refinancing and hold the property a little bit longer.
So as Pat just stated, assessing the market condition is one of the key points in first acquiring the property and then as an exit strategy. So it is crucial because it can make or break the deal. And evaluating the market is has significant impact in the property value, in the rental income, and the overall success of the returns on your investment. And the key indicators that we'll be going over tonight for market assessment is population growth, employment rates, and economic trends.
Okay, so let's start with population growth. Population growth is measuring the number of people that are living in a particular area over time. It's important to know what the population growth is because that will indicate what the demand for housing is, which will lead to higher property values and rentals. So if you have a city that has a positive population growth, which would be 3% year over year, that would be a market that will be favorable for a real estate investment opportunity. On the other hand, if you look at a market and the population growth is negative, that means that people are leaving that market for whatever reason. So you wouldn't want to invest in a property there because that means that the real estate is not going to be doing as well. The rental rates are going to be dropping and the values of the properties will be low as well. Some of the tools and the resources that you can use to check for population growth is the U.S. Census Bureau, local government and data reports, as well as real estate market analysis reports from industry sources. Or you can always go to Mr. Google and just type, what is the population growth, for example, Dallas, Texas, and it will tell you, and it will lead you to one of these resources.
Another factors that Nancy, Fran, and I really take into consideration when we look at the market or the new city that we're going to be investing in is the employment rates. The employment rate is the percentage of working age population that is employed. So why is it important? Because we know higher employment rates typically lead to a greater demand for housing and also for rental as well. So we should look at like a big company like Tesla, you know, Publix, Amazon, because we know that those large organizations provide a lot of employment opportunities, which mean, you know, we're going to have more demands in housing as well. That's why this is a key factors when we do market analysis. There's several tools and resources that you can, you know, look at when we want to do more research about employment rate. It could be Mr. Google, like Nancy said, type in employment rate in San Antonio, Texas, Florida, whatever city that you look at. Or you can go to Bureau of Labor Statistics, or BLS, Local Economic Development Agency, or industry reports and market analysis as well.
And lastly, we also look at the economic trends because the economy has influence on everything. And the overall direction of the economy includes the the gross domestic product growth, inflation rates, and interest rates. And it's important because it has an effect on the real estate opportunities that we have. It impacts property value, rental income, and the overall success of any investment. When the GDP is growing, that means that the economy is healthy and that businesses are doing well and people are making more money. Therefore, they're able to spend it on housing and rents. And some of the resources that we can use to look at what the economic trends are the Federal Reserve, central bank reports, economic forecast reports, and the Consumer Price Index.
Beautiful. Thank you, girls. So now that we've covered all this information, let's go over the key takeaways of our presentation for tonight. So understanding key metrics and identifying red flags, as well as being able to assess market conditions, will help us as passive investors to make better investment decisions. It's important for us to have a basic understanding. We don't have to know everything as a passive investor. I mean, you want to be passive, you want to be hands-off, but you still want to be able to know the basics, and knowing these key metrics and being able to identify some of the red flags, as well as assessing market conditions, will make you a better investor and will make you make better investment decisions and help you find the best passive investment opportunities that align with your goals. You don't want to end up being in a bad deal, because it does happen. And I can say from firsthand experience that it has happened to me. I've been in bad deals, and I know other nurses that have been in bad deals because we don't have at least a basic understanding of what we need in real estate to make good investment decisions.
So thank you so much for joining, our webinar. In addition to monthly webinar that we're hosting the first Tuesday of each month, we also have newsletter that going out bi-weekly. So if you see the QR code in front of you, that will send you, if you scan it, will send you straight to the page that you register for our bi-weekly newsletter. Like Nancy friend, I always stressed important for our passive investor to educate yourself, be more comfortable with, gain more knowledge before you invest, make any investment decision. So we would love for you to join our nurse-led movement toward the financial prosperity and freedom. Let's build the future together, transform your future with, as nursepreneur, we walk in your shoes. We know your pain point. We know what you're going through every day. So we would like to walk this journey with you. So don't forget to scan this QR code, and I'll send you to the bi-weekly newsletter.
And this is our personal contact information. If you scan each QR code, it'll send you to our Calendly, where you can book your call with your favorite nursepreneur. So pick which one's your favorite right now and scan the code.
Can't pick Nancy. She's in Canada, so you can't book the call with her.
Yeah, back in September. But thank you guys for being here.
And don't forget to register for our next webinar. We look forward to seeing you guys next month, and we will be speaking on the roles and responsibility of an active investor. Thanks you guys for listening in.